95% of retail day traders lose money during the largest directional moves of the week. Most view sideways action as a random, untradeable mess, unaware of the specific algorithmic processes occurring within those narrow ranges. When the market stalls into a tight lateral range, boredom and frustration set in. Traders watch overlapping candles and dismiss the environment as chop, a period where the market simply isn't doing anything. This dual pane layout reveals the disconnect between price and energy. While the candles in the top pane move laterally, the volatility compression metrics in the bottom pane show tension redlining at maximum levels. Institutional algorithms match thousands of buy and sell orders within this fixed boundary, creating the mechanics of a hydraulic press. This process converts trade volume into potential kinetic energy. Because an auction market cannot expand infinitely, it requires these periods of high-intensity matching to refuel. We refer to this inevitable cycle of tightening and release as structural velocity. What retail traders see as dead air is an active environment where algorithms aggressively trap localized liquidity to power the next expansion. Algorithmic refueling follows two specific geometric models to concentrate this order book energy. These are the lateral squeeze compression and the vertical impulse AB extension. On a chart, a horizontal squeeze and a sharp vertical pullback appear unrelated. However, both structures function identically to consolidate volume before a trend continues. These models exist to generate the massive force required for the high-velocity expansion known as the True C-Wave. Mapping the current market to one of these two energy-building models allows an operator to distinguish between toxic noise and a developing breakout. In a squeeze compression, price coils tightly within fixed horizontal boundaries, creating a narrow lateral channel. Inside, algorithms match large buy and sell blocks at high speed, filling the internal range with order book mass. This continuous matching tightens the daily variance spring, storing energy purely on a horizontal plane. Because the range is so dense with automated orders, the interior of this compression zone is a high-risk environment. Traders who execute positions in the middle of a squeeze are often stopped out by minor price fluctuations before the market actually moves. The professional response to a lateral stage is to wait. Operators keep their hands locked until price tests the definitive outer boundaries. Survival during this stage depends on the discipline to remain flat while the algorithmic spring coils. The impulse AB structure builds energy dynamically. It begins with a sharp vertical A wave leg upward. Instead of moving sideways, price immediately hooks into a B wave. This is a rapid, deep pullback designed to break below local support levels. The B wave functions as a refuel station. It flash liquidates participants who bought the initial move too late, forcing them to sell their positions back to institutional buyers. This correction flushes out weak-handed participants, transferring their energy into the algorithmic system. Operators look for the point where the liquidation ends and the original trend resumes. We identify these areas using specific structural floors, such as the chassis B floor or the hourly 55 core.
Whether the trap is set horizontally over several hours or vertically in a sharp 5-minute dip, the mechanical result is the same: the harvest of retail liquidity to fuel the next leg. Both structures eventually reach a point where the consolidated energy must be released. Price begins to press against a specific upper threshold, the DRW gate. This mathematical boundary is the trigger node, the exact line where concentrated pockets of trapped sell-side liquidity are breached. As price crosses this gate, institutional algorithms execute full contract payloads, slamming large orders into the market to capture the expansion. Simultaneously, the traders caught on the wrong side of the squeeze reach their panic threshold, triggering a massive wave of stop losses. These stop losses become active market orders, creating forced buying that accelerates the upward movement. This dual force creates a liquidity gap. With almost no resting sell orders left to slow it down, price moves through open space with zero resistance. This double-powered engine is the reason the resulting True C-Wave moves with extreme verticality compared to standard price action. These breakouts are the deterministic result of algorithmic liquidation, where the exit of one group of traders provides the fuel for the entry of another. Because C-Wave velocity is so extreme, execution must be governed by strict defensive laws.
Professional operators maintain objectivity by refusing to argue with a breakout or front-run the trigger node before the market validates it. Valid entries occur only on a clean breakout or a structural fade confirmation. Once in the trade, risk is anchored to a hard mathematical boundary. This risk is hard-coded to exactly one tick past the opposite invalidation line. This tight guardrail is necessary because if price snaps back below that line, the structural logic of the move has failed. The stored energy did not release as predicted. Effective risk management is binary. Either the market structure validates the slingshot, or the operator exits the market immediately. The slingshot operational matrix provides a map of this entire cycle, uniting the structural phases and their corresponding tactical laws. Using this matrix shifts the focus from following every candlestick wiggle to identifying which of these specific macro phases is currently active. When an operator tracks price during a squeeze compression or an impulse pullback, they are actively monitoring the loading phase of the market. This perspective transforms the trader from a victim of algorithmic variance into a precision operator who waits for the highest probability moments of the week. The ultimate objective of this entire framework is to ride the high-velocity expansion of the slingshot run. Profits are managed by scaling out at macro standard deviation milestones while holding a core position for the most extreme mathematical walls. While retail participants are liquidated in the noise of the consolidation, the operator who identifies the breakout node can enter the market with the full weight of institutional momentum. This is the result of perfect structural alignment, catching the lip of the C-wave as it accelerates into open space. Stop fighting the chop, identify the model, wait for the algorithmic spring to coil, and use strict invalidation to protect the machine while you prepare for the slingshot.